In this video, we will be discussing the basics of personal finance and providing tips and strategies for managing your money effectively. Whether you're looking to save for a down payment on a house, invest for retirement, or simply get a better handle on your finances, this video will give you the information and tools you need to get started. So sit back, relax, and let's start mastering our money together. Number 1. Budgeting and saving money. This involves creating a plan for how to spend and save your money on a regular basis. One of the most popular budgeting methods is the 50-30-20 rule, which suggests that you should spend 50% of your income on necessities, 30% on non-essential items, and save 20% for the future. For example, if you make $50,000 a year, your budget might look like this: $25,000 on necessities such as rent, utilities, groceries, $15,000 on non-essential items such as shopping, eating out, and $10,000 on savings including emergency fund and retirement. Setting financial goals, such as saving a certain amount of money or paying off debt, can also help motivate you to save more. For example, you might set a goal to save $20,000 for a down payment on a house within the next 5 years. Number 2. Understanding credit scores and credit reports. Your credit score is a 3-digit number that represents your creditworthiness. It is based on information in your credit report, which is a record of your credit history. Your credit score is used by lenders to decide whether to approve you for a loan and at what interest rate. For example, if you have a good credit score, you might be able to qualify for a mortgage with a lower interest rate. It's important to check your credit report regularly to ensure that it is accurate and to look for any signs of identity theft. For example, if you see an unfamiliar credit card account on your credit report, it could be a sign that someone has stolen your identity and opened a credit card in your name. Number 3. Investing in stocks and mutual funds. Investing is a way to grow your money over time. Stocks are shares of ownership in a publicly traded company, and mutual funds are a type of investment that pools money from many investors to buy a diversified portfolio of stocks, bonds, and other securities. For example, if you buy stock in a company like Apple, you own a small piece of the company and can potentially benefit from its growth. Investing in stocks and mutual funds carries a certain amount of risk, but over the long term, they have historically provided higher returns than other types of investments such as savings accounts or CDs. For example, the stock market has historically returned an average of about 10% per year over the long term. Number 4. Retirement planning and 401k. Retirement planning is the process of creating a plan to save enough money to live on during your retirement years. A 401k is a type of retirement savings plan offered by many employers that allows you to save money on a pre-tax basis and potentially receive employer matching contributions. For example, if your employer offers a 401k match of up to 3%, if you contribute 3% of your salary to your 401k, your employer will also contribute 3% of your salary to your 401k account. It's important to start saving for retirement as early as possible to take advantage of the power of compound interest. For example, if you start saving $500 a month in your 20s, you will have saved more than $1.2 million by the time you reach retirement age. Number 5. Insurance such as health, life, car, and homeowners. Insurance is a way to protect yourself financially in case of unexpected events such as accidents or illnesses. Health insurance helps to pay for medical expenses. Life insurance provides financial support to your loved ones if you pass away. Car insurance covers damages to your vehicle and other people's property in case of an accident. And homeowners insurance covers damages to your home and personal property. For example, if you have a health insurance, it will pay for your hospital expenses in case of any illness or injury. Similarly, if you have life insurance, your beneficiaries will receive a death benefit if you pass away. Car insurance will cover the damages to your car and the other party's car in case of an accident. And homeowners insurance will cover the damage to your home and personal property in case of a fire or natural disaster. It is important to have the right insurance coverage to protect yourself and your assets in case of any unexpected events. Number 6. Tax planning and preparation. Tax planning is the process of organizing your finances in a way that minimizes your tax liability. Tax preparation is the process of actually filling out and submitting your tax return. For example, you can lower your tax bill by contributing to a 401k plan or IRA, or by taking advantage of deductions and credits such as the mortgage interest deduction or the child tax credit. It's important to understand the tax laws and deductions that apply to you in order to make the most of your money. For example, you can consult with a tax professional to understand the tax laws and deductions that apply to you and make the most of your money. Number 7. Real estate and homeownership. Real estate is property that includes land and any buildings on it. Buying a home can be a significant financial investment, but it can also be a good way to build equity over time. For example, if you buy a home for $200,000 and the value of the home increases to $250,000, you have built $50,000 in equity. It's important to carefully consider the costs of homeownership, such as mortgage payments, property taxes, and maintenance expenses before making the decision to buy. For example, you should consider how much you can afford for a down payment, how much your mortgage payments will be, and how much you will have to pay for property taxes and maintenance before deciding to buy a home. Number 8. Understanding and managing debt. Debt is money that you owe to someone else. Credit card debt, student loan debt, and mortgage debt are some of the most common types of debt. It's important to understand the terms and interest rates of any debt you take on and to develop a plan to pay it off as quickly as possible. For example, if you have credit card debt with a high interest rate, you should prioritize paying it off as soon as possible to avoid accruing additional interest charges. Number 9. Financial planning and goal setting. Financial planning is the process of creating a plan to manage your money in order to achieve your financial goals. Setting specific, measurable, and achievable financial goals can help you stay on track and motivated to make progress towards your financial dreams. For example, if you want to retire by age 60 with $2 million, you should set specific goals such as saving $20,000 per year, starting a business, or investing in real estate to help you reach your goal. Number 10. Identity theft protection and fraud prevention. Identity theft is when someone uses your personal information, such as your name, social security number, or credit card information, without your permission. Fraud prevention involves taking steps to protect yourself from identity theft and financial scams. For example, you can protect yourself from identity theft by monitoring your credit report, shredding sensitive documents, and being cautious when giving out personal information online or over the phone. Number 11. Understanding and using online banking and financial management tools. Online banking and financial management tools are a convenient way to manage your money. With online banking, you can check your account balances, pay bills, and transfer money. Financial management tools, such as budgeting apps or investment trackers, can help you stay on top of your spending, saving, and investment progress. For example, you can use a budgeting app like Mint to track your spending and see where your money is going. You can also use an investment tracker like Personal Capital to monitor your portfolio and see how your investments are performing. Credit cards and responsible credit usage. Credit cards are a convenient way to make purchases and build credit, but it's important to use them responsibly. This means only charging what you can afford to pay off in full each month, paying your bills on time, and not applying for too many credit cards at once. Misusing credit cards can lead to high interest debt and a lower credit score. For example, if you only make the minimum payments on your credit card balance, the interest charges can add up quickly and make it difficult to pay off the debt. Number 13. Saving for a down payment on a house or car. A down payment is the initial payment you make when buying a house or car. It's typically a percentage of the total cost of the property. Saving for a down payment can be challenging, but it's an important step in achieving the goal of homeownership or car ownership. For example, if you want to buy a house that costs $200,000, you will need to save at least $40,000 for the down payment. Number 14. College savings plans. A 529 plan is a type of investment account that is specifically designed to save for college expenses. The money in a 529 plan can be used to pay for tuition, room and board, and other qualified education expenses. One of the benefits of a 529 plan is that the money in the account can grow tax-free, and withdrawals are tax-free as long as they are used for qualified education expenses. For example, you can open a 529 plan for your child and start contributing to it as soon as they are born. This way the money will grow tax-free over time and you'll have enough to pay for their college expenses when the time comes. Number 15. Understanding and comparing different types of investment accounts. Different types of investment accounts have different rules and tax implications. A Roth IRA, for example, is an individual retirement account where contributions are made with after-tax dollars, but the money can be withdrawn tax-free in retirement. The traditional IRA, contributions are tax-deductible but withdrawals in retirement are taxed. For example, if you are in a high tax bracket now, it might make more sense to contribute to a Roth IRA because you'll be able to withdraw the money tax-free in retirement. It's important to understand the differences and choose the account that best aligns with your financial goals and tax situation. We hope you found the information and tips provided in this video helpful and informative. Remember, personal finance is a journey, and it takes time and effort to master. Start by setting financial goals, creating a budget, and understanding your credit score. Take it one step at a time and don't be afraid to seek help if needed. We'll be back with more videos on this topic and other financial related topics, so be sure to subscribe to our channel and hit the notification bell to stay updated. Thanks for watching.